General Dynamics is a company that operates in the industrial sector and is mostly known for manufacturing aerospace and defense machines. Now, thanks to the conflicts going on in the world right now, the Ukraine-Russia conflict, and most recently the Israel-Hamas war, many countries are strengthening their defense, and of course, defense companies such as General Dynamics are benefiting from this. Over the past 5 years, the company is up by a stunning 75% and has risen from about $180 per share to a current price of about $304. Now, two of the most influential deals General Dynamics has made in Q2 and Q3 is first its $6.7 billion contract with the US Navy to manufacture 8 fleet oilers, and a deal for a combined $1.3 billion for Virginia-class submarines. And these are only the two largest deals General Dynamics has landed over the past 2 quarters. They have also landed countless smaller ones, for example the one for $323 million with the US Army, or the one for $299 million for Pentagon. Now, General Dynamics has released their Q3 earnings today, so let's have a quick look at that. In their aerospace sector, the revenue grew by 22%, from about $2 billion to about $2.5 billion. Their operating margin did decrease by 1%, but their operating earnings is up by about $40 million. Now, the aircraft sales of the company are up by 23%, and a lot of that is thanks to the new G400s. Gulfstream is of course owned by General Dynamics, and last year Gulfstreams have been the #1 selling private jet, with 96 being sold. And so with the release of G400s, General Dynamics is on a good path to raise their revenue in their aerospace sector. Now, moving to the combat systems sector, the revenue has decreased by about 12 million, which is a very small percentage, but the operating margin has increased by about 1.2%, which is fabulous, and the operating earnings has increased by 25 million. Now, regarding General Dynamics Marine Systems, the revenue is up by 20%. The operating margin is also up by 0.2%, and the operating earnings is up by about $50 million. And as I mentioned before, the strong growth is particularly thanks to the submarines. Now, it is clear that this quarter was a good one for General Dynamics, but now let's evaluate it on a more larger scale. So let's jump to our stock valuation spreadsheet and plug in the ticker GD. And this is where General Dynamics will undergo the 9-pillar process, which will reveal whether the company is a good long-term investment. We will also find its intrinsic value at the end of the video. Now, General Dynamics does currently pay out a dividend yield, which is sitting at 1.87%, with a dividend payout of about $5.7 per share per year, and a trailing free cash flow payout ratio of 43.5%. Now, I'm quite happy that the trailing free cash flow payout ratio of the company is sitting below 50%, as they do need to push a lot of their free cash flow into innovation to stay relevant. And so after paying out dividends, the company still has about 56% of their free cash flow to play around with. Now let's jump to the first pillar of the analysis. And here we will have a look at the 5-year PE ratio, which we want below 22. We can see that the PE ratio of the company has been rising over the past 5 years, which isn't great, as that means that the company's earnings are becoming more expensive. But we can see that the PE ratio growth has been decelerating, so hopefully the company will get their PE ratio under control over the next few years. We can see that the current PE ratio is sitting at 23.61, but the 5-year PE ratio is sitting at only 18.62, which means that General Dynamics passes the first pillar. Now jumping to the second pillar, which is the price to free cash flow over the past 5 years, to be below 21. We can see that the average price to free cash flow growth is sitting at 6.28% per year, and the current price to free cash flow is sitting at 21.95. The company did push their price to free cash flow down through 2020 to 2022, but in 23 it increased again. So the 5-year average is sitting at 23.22, which is not below the value we want to see. So General Dynamics doesn't pass pillar number 2. Now regarding pillar 3, pillar 4, and pillar 5, we'll look at General Dynamics growth. So first we want to see revenue growth in the company. The average revenue growth is sitting at 3.29%, and the year-over-year revenue growth is sitting at 8.93%. we can see that the revenue grew from $39 billion to $42 billion, and the revenue growth is actually accelerating over the past few years. Now moving to pillar number 4, the net income growth. The average net income growth is sitting at about 1% over the past 5 years, with the year-over-year net income growth sitting at almost 10%. Now jumping to pillar number 5, the free cash flow growth over the past 5 years. And this pillar is probably the most important one for me out of the 3 pillars, as free cash flow is the life energy of the company. They pay out their dividends from free cash flow, they buy back shares, they pay off debt, and they use it to develop the company. We can see that the average free cash flow growth is sitting at almost 15.5% and has grown from $1.9 billion in 2019 to $3.8 billion in 2023. So that is just phenomenal growth. Now let's jump to the 6th pillar, which is the 5-year profit margin to be above 10%. And the reason for why we want the profit margin to be above 10% is that companies that have a higher profit margin tend to have better growth. We can see that the 5-year profit margin of General Dynamics is sitting just below 8.5%, and the current profit margin is sitting just below 8%. The average profit margin has been decreasing by about 2.15% every single year, decreasing from 8.85% in 2019 to 7.84% in 23. But this isn't anything I would be too worried about, as General Dynamics is a well-established company that has been doing well with the lower profit margins, and of course it is in the industrial sector, which does tend to have lower profit margins. Now jumping to pillar number 7, we want there to be a decrease in shares outstanding. And the reason why we want there to be a decrease in shares outstanding is that with time, when the company buybacks shares, you as an investor will own a larger percentage of that company. So we can see that year over year, the shares outstanding has actually increased by 0.65%, but over the past 5 years, they have decreased by about 0.93% every single year. So we can see the nice trend line right here, decreasing from 288 million to 273 million in 23. We can see that the company has been buying back less shares every single year leading up to 2023, and in 2024 they actually issued out more shares. Now I actually believe that them selling out shares in 2024 is for the good, and the reason for that is that the company needs to raise more capital to accommodate the rising number of deals. Now jumping to the dividends tab, where we want to see consecutive dividend growth. And the reason why we want to see consecutive dividend growth is to achieve the dividend snowball effect. And if you don't know what the dividend snowball effect is, make sure to check out my video which I did just a few days ago. At the end of this video, there will be a link on the screen. Now the 5-year dividend growth of General Dynamics is sitting at 5.33% every single year over the past 5 years, which is a very decent yearly dividend growth. We can see that this dividend growth is higher than the average, and that the company's dividend yield, sitting at 1.88%, is higher than the average stock dividend yield as well. Now if we have a look at the graph to the right, we can see that the company has actually been decreasing their dividend growth year over year. And the reason for that is that with the growing conflicts, the company needs more free cash flow, which they can pump into the growing deals. Now jumping to the final pillar of the analysis, the long-term liabilities of the 5-year free cash flow negative dividends to be below 5. And this metric basically tells us whether the company generates enough free cash flow to cover all their long-term liabilities and their dividends. So we can see that General Dynamics is currently sitting at a ratio of 0.96, which means that they can pay off all their long-term liabilities while paying out their dividend in about 5 years, which is phenomenal. We can see that the company has actually paid down some long-term liabilities through 2021 to 2023, and currently they are sitting at $14.7 billion in total liabilities, which isn't that much considering the amount they generate in free cash flow every single year. And now let's finally move to calculating the intrinsic value of General Dynamics. So first we will use the Graham's formula revised. And here, by using the Graham's formula revised, we will get an intrinsic value of $339.53, which is 11% higher than the current trading price, showing us that General Dynamics has very strong earnings per share. Now moving to the second valuation, the discounted cash flow valuation. And here we analyze the free cash flow growth strength of General Dynamics. So we can see that in 2019 they were generating about $2 billion in free cash flow every single year, and in 2023 they were generating about $3.8 billion every single year. So that is an average growth rate of 19.31% year over year over the past 5 years. Now the analysts project growth rate of 8.19% year over year, and I will plug in a growth rate of 12% as I want to be a bit more conservative. Now using the growth rate I plugged in, I will calculate the future free cash flow. And as I want to account for inflation, I will plug in a discount rate of 7.5%, and using that I will calculate the present value of that future free cash flow. And when I sum up all of that future free cash flow, add any cash and cash equivalents, subtract total debt, I will get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $444.49, which is quite higher than the current trading price, hinting towards that General Dynamics has very strong free cash flow growth into the future. Now moving to the third valuation model, the multiples valuation. And here we will compare General Dynamics to companies which operate in the same sector. So in this case, companies that operate in the aerospace and defense sector. So we will take HomeMed, Northrop, and Lockheed. We'll take these companies' current stock prices and divide by their earnings per share to get their PE ratios. We'll then average out their PE ratios to get an average PE ratio, which we'll multiply by the earnings per share of General Dynamics to get an intrinsic value of $428.97. Again, quite higher than the current trading price, showing us that General Dynamics might be undervalued compared to companies which operate in the same sector. And now moving to the final valuation model of the video, the dividend discount model. And here we will plug in the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 6.67%. Now I will project a growth rate of 5.80%, and using the next year's dividend, which we calculate using our projected growth rate, and the discount rate which we plugged in at our discounted cash flow analysis model, we'll get an intrinsic value of $328.60, which again is higher than the current trading price. And now finally moving to the ultimate valuation, where we will average out all the 4 models we just did and get an ultimate intrinsic value of $385.32, which is 27.41% higher than the current trading price of the company. And if we do plug in a margin of safety of 20%, which is quite a high margin of safety, we still get an acceptable buy price at $308.26, which is about $6 higher than the current trading price. Now, as I do believe that the conflicts going on in the world right now are not about to end, I do think that buying a defense company such as General Dynamics might be a good addition to anyone's portfolio. Now in this video we saw that General Dynamics is doing very well. Over the past 5 years they have been growing their revenue, their net income, and their free cash flow. Their long-term liabilities are sitting fairly low compared to the free cash flow they generate. They have growing dividends and a very nice PE ratio. And of course, based on the 4 valuation models we just did, the intrinsic value of the company is sitting higher than its current trading price, meaning that the company might currently be undervalued and it might be time to buy the company. And so if you did enjoy the video, make sure to leave a like and let me know down in the comments which company you'd like me to evaluate next. Also, if you'd like to download these spreadsheets for your own personal use, you can do so at my Patreon in the link in the description. And with that, thank you for watching.